So I get asked this question a lot, which is how do I choose my strike prices? I'm just going to show you guys my thought process of how I do it. So the two steps that I follow is, do I want to own the stock at this price? And two, is the risk worth it? And the way I determine that is the ROR, or return on risk, is what TD Ameritrade calls this column add-on that I'll show you guys a little bit later. So some common methods that people use in the wheel strategy to determine the strike price is either using delta, the percentage discount they would get the stock at, and my personal favorite way is the ROR, return on risk, is what they call it, but basically it's the return on the cash and not the buying power utilized, which I think is very important if you want to do cash secured puts and not be selling naked puts. So first one, delta. This is probably the most common. Commonly I see they aim for the 30 delta. The reason why I don't go only off of delta is it doesn't take into account implied volatility, which can really drastically affect the return that you would get, even though the deltas would be the same. So for example, down here we Square, if you were to sell a put on Square in September 2nd, 31 delta, you could get $600, which would be 2.3% return if you had to put down $26,000. So the strike price would be $260. So that means if you had to buy the shares, you'd have to put down $26,000 and you'd be paid $600, which is 2.3% of that. That's the return on risk. And then these are monthly contracts. I try to aim for around 30 days. Now, if you were to sell essentially the same delta when the implied volatility was different, so if you were to sell it December 3rd, 0.27, this is the closest to 30 delta at the time. You could sell, or you would be selling 175 strike price, collecting $525, and that would be equivalent to a 3% return on risk, even though it's like the same delta, actually lower delta. So you have less chance of assignment and a greater return on that trade, even though the deltas are pretty much the same. So these are screenshots that I took. So this is in December 3rd when the implied volatility was higher. So you could have even gone a strike above at 21 delta and collected the same amount of premium, 2.38%. So that's what I mean, that I wouldn't just look at the delta. If you want to invest in the S&P 500 index, buy and hold for a year, historically, you're going to have a 10% annual return. Some will say 10, 12%, depending on the website. That equates to 0.83% a month. And the advantage is you have diversification and you don't have to manage anything. If you're selling cash secured puts, like in the wheel strategy, most likely you're going to be choosing individual stocks. And so you're going to take on higher risk because there is a possibility that an individual stock can go out of business or can have bad press, or there could, be bad news and the stock can tank. Versus the S&P, if that happens, if one single stock goes down, it won't affect all of them. I like to aim for 1.3% because So you're taking on more risk because you're choosing individual stocks, and you also have to manage your positions. So you're basically working at least monthly to open and close contracts. So when you take on more risk, you should be compensated more. It wouldn't make sense to make a ROR of equivalent of buying an index, because you're adding risk, you're spending more time managing the positions. So I like to go at least 1.3% or higher if possible. If the implied volatility is higher, you usually can go at least 2-3%. So for example, Lucid has pretty high implied volatility. So this is an example of a trade that I would take. So if you go to a 27 strike, this is a 2% risk on return. This is this column here. 10 delta. So that's like a 90% chance it won't go in the money. And then you'd collect probably $55 for selling a put. Now, that doesn't sound like a lot of money, but if you think about it, 2% a month is 24% annualized. And it's not like you would sell this every single month on Lucid, but if you were to only open up positions with a 2% return on your risk, you would have increased your account size by 24%. So if you had a 100K account, you'd have realized $24,000. So that's a really good return. Now I'm going to show you guys how to add it on thinkorswim. So you'd want to go over to the trade tab and then open up one of the option chains. I'll just go for the 27 days. And then these are your columns here on the put side. So then to get this ROR, you want to go to Layout, Customize. And then since I already have it here, I'm going to remove it. So it should look like this. You should have some presets here. And then you want to go over to the left, click on this, and type return on risk. So there, now notice there's also return on capital, but the one you want to choose is return on risk, because the return on capital utilizes the buying power instead of your cash. Then OK. And it should come up, it should show up here on the right. And this is just a really quick way to check the return if it's even worth doing. And I also like to have the delta column right next to it. So if we go over to Microsoft, you notice that a lot of the strike prices are way under 1%. So usually it's not that profitable to sell cash secured puts on Microsoft unless you're really close to the money or implied volatility goes up, and then you should be able to sell at a lower strike. All right, that's it for today. I hope that helps. Let me know if you guys have any questions down in the comments section, and I'll try to get back to you. All right, I'll see you guys next time.